Do you know how a company goes bankrupt? Many people think it happens when a company starts losing money and gradually accumulates larger and larger losses until it eventually goes bankrupt. However, that's usually not the case. In the overwhelming majority of cases, a company goes bankrupt because it borrowed too much money and can't repay those debts. This struggling company may still be making money, but if it can't pay its debts, it has to declare bankruptcy. Alright, but why is this a problem? I'll try to explain it in this video. Most of us remember times when interest rates were relatively low. After the big banking crisis in 2008, central banks began lowering interest rates to support the economy. The interest rates set by the central bank significantly influence the interest rates at which banks will lend to you. So, some of you may remember loan interest rates around 1 or 2%. With such low interest rates, it can be worthwhile to borrow money and invest it somewhere. When money is readily available, people borrow more and, as a result, spend more, driving the entire economy. This applies not only to individuals but also to companies. The lower the interest rates, the more companies borrow to invest in their business. So, what does this mean? Well, you can think of it as playing chess against a computer. When interest rates are low, it's like playing on easy mode. It's easy to borrow new money and then refinance it. But when interest rates are high, it's like playing against a grandmaster, and if you have a lot of debt, you have a big problem. The corporate world typically works in a way where loans are not typically paid off. You might be wondering how this is even possible. The whole point of loans is that you borrow money and then repay it with interest, right? Yes, that's how it works. However, what companies do is borrow money and then, when it's time to repay, they simply borrow more money to pay off the original debt. And the cycle continues. Companies borrow new money to pay off their old payments. As long as certain conditions are met, this is not a problem. But here's where the issue arises. From 2008 to 2021, refinancing was very easy. Interest rates were low, and money was readily available. Companies borrowed and, instead of repaying the debt, they borrowed new debt to pay off the old one. And because money was so cheap, they typically borrowed even more to fuel their growth. The amount of debt kept growing, and the vast majority of companies planned to refinance this debt. And since interest rates were low, it worked without significant issues, and we didn't see many bankruptcies. We were basically playing the game on easy mode. Everything was easy. However, then came the pandemic, economic stimulus, the war in Ukraine, and inflation. To fight inflation, central banks had to raise interest rates. That means that when you go to a bank now, you might get an interest rate of, say, 6% instead of the original 2%. This must be making many companies' management nervous. Let's say you borrowed $100 million for 20 years. With a 2% interest rate, you pay $505,000 per month. But with a 6% rate, you pay $716,000 per month. So, when companies have to repay their debt, they will have to borrow again, but this time they will have to pay much more in interest. Another question is about the availability of money. If money is not as readily available, companies may not be able to borrow as much to cover the entire amount and may be forced to sell assets, issue new shares, or declare bankruptcy. Companies that are conservatively financed will most likely not have any problems. On the other hand, companies that borrowed too much may run into trouble. Interest rates started rising only a year ago, and we may not have seen their full impact yet. Many companies finance their growth through bonds. These work by borrowing money, paying a coupon, i.e., just the interest, and returning the entire amount borrowed one day. That means that as long as this day doesn't come, a debt-ridden company won't have any problems, and higher interest rates won't affect it. But when the day of bond maturity comes, it can be a huge problem for the company, and it will either have to borrow at a disadvantageous rate or sell assets, issue new shares, or go bankrupt. So, many companies may feel the impact of high interest rates when their currently issued bonds mature, and this can happen at any time within 1, 3, 5, or even 15 years. This depends on the company. And of course, there's a big question about where interest rates will be in, say, 3 years. Is it possible that they will return to 0%? Is it possible they will remain high? Unfortunately, no one knows. Fortunately for investors, it's not that difficult to assess whether a company could run into problems due to high interest rates. How do you figure that out? For our luck, we can review the financial results of publicly traded companies every 3 months. For instance, we can see how much money they have or how much they owe. Many companies even show in various investor presentations the year in which they will have to repay their debt. Information about debt can be found on the company's balance sheet. Ideally, we want it to be as small as possible. We can compare it, for example, to the profits or free cash flow and calculate how long the company would be able to repay this debt. In an ideal scenario, the company's cash should be able to cover all its debts. In such cases, the company doesn't need to borrow and can easily repay its debt. Alternatively, you can check the ratings from companies like S&P Global or Moody's. These companies evaluate how safe it is to invest in a company's debt. Often, companies proudly display this rating on their investor relations websites. So, what's the conclusion of this video? In recent years, we've had an easy mode, where companies and people could borrow at low interest rates, and most companies, instead of repaying debt, just financed it. It worked great until inflation and rising interest rates came. If interest rates remain high, and it's worth mentioning that nobody knows where they'll be in a few years, some companies with excessive debt may run into problems, and some of them may even go bankrupt. Whether this will happen is difficult to predict. For instance, today, the number of companies going bankrupt is still relatively low compared to the historical average. However, it usually takes a few years for the real impact of rising interest rates to become evident. Thank you for watching this far. Liking and sharing this video is still free, and in return, here's a quote from Warren Buffett, who says, "Rule number 1 is never lose money. Rule number 2 is never forget rule number 1. Thanks, and see you next time."